What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers up here on the left. So as always, I have the broad market for you. We have our core list of companies that we're always watching. All of these pretty much passed through their earnings cycle with the exception of Alibaba. And then I also have 5/6-ish trade ideas for you headed into the upcoming week. Some of these were recommendations from the Discord members. If you want to check that out, it's linked down below in the description. It's completely free, along with some of our other resources. That being said, we're going to jump into some monthly charts on the broad market to start. Let's get into it. Jumping right into our SPY monthly chart, talking about candle structure and location as we always do. For structure, we've got a little bit of an interesting month simply because we have a bit of everything, right? We have an upper wick, we have a nice solid green body, as well as more of a prominent lower wick than just, a flat low there. So to me, it's completely bullish, right? We pulled back, we had the opportunity to go lower, we respected the prior month's low, and we also set a new higher high. So everything about this bar that was printed in the month of July strikes me as bullish. In terms of location, obviously new all-time highs has to be bullish as well. The last thing I'll leave you with here from the monthly perspective is that this is now the 9th month ever since November, October in here, where we've continually set a new higher high every single month, okay? And we've also respected the prior month's low every single month as well. So there's no reason to really be bearish yet until we either A, do not set a new higher high on the monthly, or B, take out the prior month's low. So until that happens, again, no reason to flip your bias to bearish on at least a larger time frame perspective. Let's drill down now to our weekly time frame, see if we are noticing anything here. Completely bullish candlestick. Again, a little bit of an inside doji here up in the upper third of this overall candle range. That strikes me as bullish on slightly decreased volume down below, which again, as you're consolidating, that's what you want to see happen, volume taper off. So that's completely bullish in my opinion. We set a new higher high and of course did not even come close to the prior week's low. So no surprises here from the weekly perspective. All trend lines are still intact, this one as well as this one here. So things are looking good from the weekly. Let's drill down now to the daily, talk about tradable levels into the upcoming week. If we just zoom in a bit here, what did we sort of mention in last week's video is a likely scenario, given the fact that, the backdrop was 5 days of essentially straight up. We were talking about the fact that the market probably needed a breath and going sideways would be, the more bullish outcome in terms of consolidation. Obviously, more bullish would have been just continually moving straight up, but this sideways consolidation, pulling back to nearly fill the gap, but not all the way, strikes me as continued bullishness, right? This is price acceptance up here at the highs, as opposed to, straight out price rejection, even on the backdrop of some pretty nasty earnings, which we'll discuss as we get into some of those charts. So for me, the S&Ps are exhibiting extremely bullish activity here, consolidating up and kind of in this box. So you can play this as an area of balance. Basically, what we're looking to do is just be neutral, fade the highs and lows of this box until there's a clear breakout in one direction or another. So that being said, obviously to the upside, we're looking at blue sky levels, whole and half dollars, intraday levels that do form. Just to give you an idea of where a target could be based on the range of this consolidation, we'll actually make it something like that, and then we'll just do a little box on top like that to kind of mirror it. We always look for a doubling of that range, and again, that target would be up closer to 444.15. Okay, so that is kind of an upside target, very rough, just based on the breakout of that consolidation range. Obviously, you have some levels to pay attention to here. We have 440 as critical resistance. You can see we peaked our heads up above it a couple of times, but never really got any clean price acceptance. So still looking at that as a major area of resistance. After that, sure, a little bump in the road, if you will, at 441.80. But after that, those blue sky targets we just discussed. To the downside, or first, let me actually address these upper wicks, right? Am I concerned about those? Slightly, but not really, right? If we think about what price actually did and not read too much into the upper wicks, did price really sell off that aggressively? Were the sellers really able to take control that aggressively? Absolutely not. So that to me is indicating that there still is some buying presence. We filled the gap above there on Friday, so that's healthy. And, again, just a balance up here towards the highs. Downside levels will remain the exact same as what we discussed in the midweek market update on Wednesday. This gap underneath us should now act as a target on any sort of breakdown, probably underneath Wednesday's low, instead of a range to trade through, right? The gap is very small now, and it's just going to act as a target instead of a, something to take advantage of trading trading through that range. The next thing after that is still the support trend line, which if we get into it should provide some sort of daily higher low. If it does not, then the area to watch and essentially hold after that would be 431.70, simply because, this was a major low down here. If we pull back into this and do something like that, that would set up a nice scenario for a HL. Excuse me, let me get the H in there first. Higher low, continuing this daily uptrend that we're in. Now, if that doesn't happen, we form some sort of lower high, so on and so forth, just like we discussed on the monthly, then maybe it's okay to start shifting your bias short. But until that happens, absolutely not. We're bulls inside of a bull market. The last thing I'll leave you with here is a Fibonacci retracement from high, or low to high rather, and just sort of point out here that the 38.2 is still well below us, right? So we could afford to essentially pull back into that support trend line and be completely bullish still on this pullback, on this move higher. That would be a healthy pullback area. Just wanted to give you that heads up, as opposed to just, relying on the support trend line. It's kind of in the middle there, as you just saw. Moving over to our Q's monthly chart. Now, same exact sentiment sort of check as SPY. Obviously, we made a new higher high. In talking about candlestick structure, completely bullish candlestick as well, barely even overlapping the prior month's range. Sure, there's a little bit of an upper wick, but as we'll see when we drill down to the daily, not a huge deal there in terms of what's actually happening with the consolidation. Now, with this one, this is sort of the sickness pullback, if you will. And from there, we're obviously much higher than what the S&Ps has done. So Q's, again, if you're thinking about allocating money long, is this the greatest trade location to be doing that? I would argue not really. In the Qs, we have seen a couple months here of either sideways or pullback, so I would watch out for that first before allocating maybe like a 10-year outlook position to something inside of the tech space. So just some longer term thoughts there on the Qs, but certainly not trying to be bearish in an overall bull trend here in the QQQ. Clearly higher highs, higher lows for a number of months in a row now. Dropping it down to the weekly now, just to talk about anything that we're seeing here, kind of just like the S&Ps, a nice bullish sort of consolidation and hold up towards the highs. Obviously, the pullback is a little bit deeper. It's not really so much in the upper third as more, compared to the S&Ps, rather in that upper half. Okay, so not the end of the world, but certainly noteworthy that it didn't quite make as high of a high, and it pulled back a little bit deeper to a lower low than the S&Ps. Obviously, Amazon dragging this one a little bit lower. So we'll drill down to the daily now to talk about tradable levels into the upcoming week. What we had on this Tuesday, kind of interesting little liquidation break, if you will, but obviously we've consolidated back up into this range here, which is kind of the mirror image of what we just discussed in the S&Ps. So I see that as bullish sideways consolidation as opposed to a more dramatic pullback through price. That being said, again, we recovered on this gap down into Friday from Amazon earnings, filled the gap essentially just off by maybe a penny or two, but close enough for me to consider that the market doing what it needed to do. And right now we're just in the middle of this overall range, right? If we do something like this, and just remembering that the range is being defined as that, it's never a good idea to be initiating newer positions inside the middle of a range. I'd really advise you to wait until you either get to the edge here or back to the edge here. Sure, you could have taken the long off the bottom end of support, traded up towards the middle, trail your stop higher until we get to the top, obviously looking for blue skies on the breakout of 368.50. If we do something very similar to SPY in terms of maybe measuring a move based on this area of consolidation, just giving it a very quick and rough eyeball test. These numbers are not concrete, but a breakout should take us up to around 370, 371. That would be an upside target in the blue sky areas here on the Qs. Now to the downside, same exact sentiment sort of exists as with the S&Ps. Obviously, after 5 days pretty much straight up, pretty nasty liquidation break, this strikes me as bullish. But if we do go lower, 360, this is kind of the line in the sand, right, for a new daily higher low to form. Anything lower than that, I'd probably argue we come back down to the bottom end of this range, which is around 355.20. After that, again, same levels that we discussed in the midweek market update on Wednesday. And last but not least, we have IWM Russell 2000 in our small caps from the monthly perspective. And this chart is obviously much different than what we've seen everywhere else. In terms of candlestick structure, a large red-bodied hammer, so certainly still a hammer, but with a red body here, indicating that we did not retrace 100% of the down move here in the month of July. So it's not the end of the world. Remember that we are still consolidating in this overall range. We've discussed this for quite some time when we're looking at the weeklies and even the daily charts on the Russell, and it's fine. I I mean, look at this, nice pattern that's forming. It's basically a huge monthly bull flag that's been in play now for, how many months is this? Let's just count them. 1, 2, 3, 4, 5. I'll even say 6 there from this month here from February. So to me, this consolidation, price acceptance at the highs strikes me as bullish, right? This is acceptance as opposed to pure price rejection, something that would look like that. So let's drill down now something to the weekly. We'll just go through all of them. Obviously, as we know, kind of stuck in the middle of the range. That's been the story here on the IWM until we break out one way or another of this box. I really don't advise that you get overly directional or overly aggressive in equities as a whole. Remember that we use this as more of a sentiment check as opposed to a vehicle to trade outright. And right now, it's just kind of middling, right, which is telling us neutral risk. Don't be overly aggressive, but don't also go out and sell all your positions until we break down and out underneath that area here on the box that we've just drawn in the IWM. Flipping over to our daily just to discuss some levels. Again, not much has changed here. We're right at that 220 or 222.50 area. 2 inverted hammers there Thursday and Friday. Maybe we dribble a little bit lower. You have the support trend line at 215 underneath us, as we've discussed. 208 is kind of the line in the sand for risk neutral to the downside. Anything underneath that start to raise a little bit more of a question mark, saying, okay, is the market going to roll over a little bit more? This is kind of signaling risk off, so on and so forth. But until we actually get there, not a whole lot to worry about. Same goes to the upside, right? If we get up here, the question starts to become, okay, is it risk back on again here in the small caps? And that level is up around 234 the whole dollar. So IWM as it currently sits, not advisable for a tradable area here, smack in the middle of the overall range. Let me illustrate that one last time for us here by doing something like this. Here is the middle, pretty much right at our 222.50 mark. And again, when we trade in the middle of the range, not a great place to initiate any new trades. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. Kicking off our companies here with Apple, I want to point out that even on earnings, right? So we had earnings here. The company price moved a little bit lower into the support trend line, but it held. And now on Thursday and Friday, we've essentially seen 2 days of identical balance, even with the backdrop of Amazon just being downright ugly. So for me, Apple is going to be all about this 146.50-ish mark. If we can take out that area of 2-day balance highs, the high of that indecision doji in there as well, I would argue we probably come up and revisit 150 once again. This is acting as a bit of a double top, but you never really get overly bearish on those patterns unless you take out the neckline. And the neckline in this case is down here at 141.69. That would also coincide or, by fact, have to be a support trendline break as well. So no reason to be bearish in Apple unless either of those two things happen. If it does happen, obviously the gap fill underneath from 137.77 to 137.30 is your target. Again, this is not a range to trade, rather just an area on the chart to use as a target should anything more aggressive to the downside develop. But as the chart sits, again, this is no more than sideways acceptance up here, bullish consolidation at the highs after a very impressive run. So don't forget that this is bullish from an overall context. Jumping over to Netflix now. This one obviously had earnings a while ago, not really a factor to discuss anymore. But what I do want to point out is the potential for a support trend line like that to be struck in. We did obviously form a higher high, but now we've formed a lower high. So whenever that happens, you generally do not trust as much this support trend line for that next touch to be a buy. You're rather looking for it to break and potentially take you lower to your next critical areas of support. In this case, that would be around 500. So that's just one thing that I'm paying attention to. Obviously, we printed a green candle there on Friday. We're getting tangled up in the critical moving averages, 250 respectively there. So really no directional bias as of yet. But if we come into the support trend line, I'll be watching very closely to see if we get some sort of break there, which could take us down to 500. Anything after that would probably be likely a revisit down here to 487.30. Now to the upside, of course, we can't ignore those levels as well. Would wait to kind of be bullish here on Netflix until we take out 521 with some authority. You have a bump in the road here from that high, but really watching out for the rotation up to our next major area of resistance from in here around 533.81. Remember, Netflix has kind of been a very choppy one, at least for any sort of overnight swing trade directional type of bias. So I would take this one on a day-by-day case. Jumping over to Tesla now. My goodness, what a last couple of days there of the week. Thursday and Friday, just completely bullish to the upside. Thank you to one of our members who called out Tesla on the breakout there on Thursday. Appreciate you, man. But after that, what are we looking for going forward here? Obviously, the break of this area of resistance is going to act as a pressure cooker top. In the same day, I would really expect it to go to about 710. After that, watching for continuation up into possibly this 750 area of resistance from in the past. Ideally, it goes up and meets this high way up around 780, but we're not going to push our luck. We can clearly see there are some wicks, historical wicks in here around that 750 mark. So that's the complete bull case inside of Tesla upside targets for the upcoming week. Who knows? This thing is it can act as a rocket ship. It has done that in the past. You can see these massive moves from back in there. So there's nothing saying it can't do that again, but 750 would kind of be that upside target for the week, at least in my opinion. So a break of the resistance trend line looks good here. To me, it would want to hold on to 667.53 as an area of support on any sort of pullback like that, simply because it was a major breakout area. It should do something like that if it's making forward and upward progress here in Tesla. This would also be, if I'll just remind you of what we do on this channel, a higher low. So from a trend perspective, that would be healthy. Anything back underneath puts into question the sort of breakout that happened here, simply because we're trading back into this kind of choppy range, and I would probably expect more chop in between that 667.50 and the 630.50, which, as we know, is a critical area of support, simply because prior resistance then turns to support once, twice, and even 3 times here early on in the Tuesday session. So to me, 630.50 is the line in the sand to remain bullish on Tesla. If it really collapses underneath, you have 600 psychological, but I don't think that's a likely target for the upcoming week. Alibaba, my goodness, words cannot describe the ugliness of this chart. We have earnings coming out on the 3rd, and it looks like they are probably going to be before the market. After the market. Okay, so before the market. I was right, 6:30 a.m. So keep that in mind. Should give some sort of gap here in Alibaba, not like we don't have enough of them already. All I'm going to leave you off with here is where the gaps are at. So gap underneath us here, gap above us here, another gap here, and a last and final gap up here. It doesn't make sense to even try to talk about where this is going to head into the upcoming week. So those are your gaps. Those are going to act as targets. Remember, if we trade into them, they should fill with relative ease, just because there's not a whole lot of price history there. And that's kind of going to be it here on Alibaba. Day trades only on this one for obvious reasons. Jumping over to Facebook, 2 gaps in play on this one, not as ugly as Alibaba, but simply areas that are going to act as targets, right? So to the upside, we clearly have a gap from 365.50 up to about 367, we'll call it for a nice round number's sake. That'll be an upside target should we get back above this 356.75 area. Remember that was a prior breakout area. It was acting as support there on sort of Thursday, but with Amazon earnings, obviously the whole tech market sort of moved a little bit lower. We'll discuss Amazon in a minute here, but it's trying to recapture it, right? So I would keep a close eye on 356.75. If we go higher, there's your first target, and obviously after that, you're looking for a move back up towards these highs around, let's call it 375, the whole dollar. To the downside, obviously there is still a gap underneath us, which is not completely filled. So underneath 352.86 fills for about $1 down to 351.71, and coincides just by chance here with our support trend line. So looking for a long off of this level for a move back higher. Obviously tight risk, stop just underneath. If it breaks for some reason, obviously you stop out. If you didn't get long in the first place, if you're saying, you know what, Matt, you're crazy, we're just going to go short Facebook, fine, do that. And your target would be down here around this 345 whole dollar. 50 SMA will probably meet you there for a super support early on in the week. That would probably be as far as I would want to push it here to the downside, simply because that would be a nice area, right? If we just think about what we've been doing recently, coming into here and bouncing would give us a nice higher low based on this being our prior low. So to me, that would make sense for the chart here on Facebook and maintaining this daily uptrend. If it really collapses and gets going, obviously you have some levels mapped out to the downside, but overall, Facebook has been in a screaming uptrend for quite some time, and until we clearly form a lower low or a lower high, I'm not willing to be bearish. So NVIDIA, looks like I lied in the intro there. They also have not reported earnings yet. That one's quite a ways away, mid-August, so not really a concern as of yet. I will note that we have broken this resistance trend line here, kind of sideways through time as opposed to aggressively through price action like this. So, the way we're going to play this is simply now watching for a breakout above our 198.50 mark. If we can do it, looking for all-time highs after that. If that does not happen and we just consolidate sideways here, you're looking at this as an overall range. And remember, here's your 50% 10% mark at about 192.83. Not really advisable to take or initiate new trades in that area until we resolve this area of balance. To the downside, your final sort of support line in the sand is going to be here at 187.50, simply because that's the major pullback low off of the support or resistance trend line, before trying to attempt to break it there. 50 SMA note will add in a super support at that level. So 187.50 is that line in the sand to the downside here in NVIDIA. If it breaks, just walk down your levels. Critical support at 178.66, and then after that at 172.23. Microsoft also sort of consolidating up here towards the highs as opposed to aggressively pulling back through price. So to me, that's more bullish than bearish. Sure, we have a gap underneath us from 283.80, which actually has slightly filled more than that. So the low of this candle here on Tuesday is actually at 282.95. So mark that off as where the gap officially starts. But I like this area at 283.80 simply because we have a lot of price history there, right? Touch, 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 as well as here on Friday as well. So that's really the more important area. But in terms of gap, remember that level we just pointed out, closer to 282.95. So for now, if we break down underneath, obviously gap fill is the target. We're kind of at that support trend line from the daily perspective, so we'd like to see it bounce. But if it goes, it's not the end of the world as long as we form some sort of daily high or low anywhere between here, right? That's where we can afford to do it. So if the gap does fill and we move lower, you want to see a higher low eventually hammer itself out anywhere probably between 280 and 277.50. After that, we're kind of threatening to make equal lows with this here around 275.23, which would set up the case for a head and shoulders, right? That would look something like this. Just kind of thinking in terms of scenarios. Again, if we did not form that, we formed an equal low, did something like that. There is your head and shoulders pattern. This turns into a flush point at the neckline. That's, very speculative, but that's just how my mind thinks. So to the upside, if we take out the all-time high, this 290 area, we're looking for blue sky levels, whole and half dollars, intraday levels that do form. Just to give you an idea of what a range doubling breakout would bring us to, that would be right around 295.40. So keep that in mind as a potential target to the upside. Not saying it has to go there, but if we do double the range and fulfill that sort of technical trade, if you will, that would be the area to watch. And then last but not least, the not so beast this week, we have Amazon. Obviously massive, about 300-point gap down here on earnings. But what's kind of funny is that, how long have we had this line here on the chart for Amazon? We've had 3309.46 on the chart for quite some time, and that's exactly where the lower wick was. So just kind of cool, the power of technical charts. Not saying that I bought it. I'm not saying I did anything with Amazon at that level. I'm just, amazed at how this sort of works sometimes so close and to the penny. So the obvious thing to pay attention to here is any moves over Friday's high probably takes us into the gap, which starts to fill aggressively, right? On a gap this large, anyone who's short or shorted on essentially Friday, if we move into the gap, they should start to feel some pain, right? So think about that. Where's the pain start? I would argue over Friday's high for anyone who is short. Your targets above are kind of, loose at this point because, obviously the gap, but we also have some prior areas of price interaction. I'd keep a close eye on 34.30, 50 SMA after that, the blue line, of course. And if it really gets going to fill the gap, I'm not saying it has to do this in 1 week at all, but if it really gets going, this 35.50 mark should definitely be on your radar as an upside level. Now, say this completely rolls over and it breaks down underneath 3309, those shorts are going to be happy. Anyone who got long thinking, this breakout here from this overall range of consolidation, I was one of them, right? I certainly took that break in some long-term accounts in Amazon. Where do we start to feel some pain? Obviously, we're feeling it already, but where do we really not want this to go? Probably all the way back down here. I'm not saying, again, that Amazon is going to do that in a week, but what I am saying is, you got to think of the dynamic in play here. Some people are completely fine just averaging into their position, knowing that, okay, we're in the middle of the range. Hey, what if we go sideways for another year or two? Fine, I'm at the average price, give or take. So think of those people also who are potentially thinking of this as a buying opportunity here in Amazon. It's not clear to me yet which direction we're going to go. Whenever you suffer a massive gap, something of 300 points in nature is just kind of one of those question marks. So you have some levels to pay attention to. The 200 SMA is underneath us. If we go lower than that, line in the sand, at least in terms of trading, right, would probably be around 31.32. If we get all the way down here, what do you think? Probably looking for a long on any sort of hammers simply due to the oversold nature of this move that got us here in the first place. So those are some rough thoughts on Amazon. Really going to wait and see how the price action develops before getting more aggressive in terms of trading this. Quick reminder to hit the thumbs up button if you have not done so already, and consider subscribing to the channel. Jumping right into our first trade idea, very, very similar picture to what we just saw on Amazon with this massive gap down here in Pinterest, but obviously our y-axis and range here is not nearly as large, only suffering from about a 10 to 15-ish point gap down here in Pinterest. And what I like about this is the prior historical area of support that we're coming into, closer to 55, the whole dollar. With this inverted hammer that happened after the gap down, what that's telling me basically is that buyers really tried to get something going into the gap overhead, but they were not successful, right? So sellers bat it right back down. I would expect a little bit more downside activity here in Pinterest. So if we do come into that sort of 56, 55-ish area on the chart, looking for a dead cat bounce long here. Again, we're not saying that Pinterest is going to come all the way back up to about 85, 86. No, not at all. We're rather just looking for a quick scalp to the upside here. Maybe it bounces up to 60. Maybe it comes back up and retests the bottom end of the gap. That's kind of all we're looking for here in Pinterest, not a major reversal all the way back up towards the highs. Now, if you want to go long in a longer term account with, shares instead of options, fine. Take the long down here, place your stop loss just underneath and just kind of ride it out into the future. But in terms of trading and scalping options, the dead cat is really the preferable sort of setup here on Pinterest. Next up, we have VALE, and VALE is just slamming directly back down into the bottom end of this consolidation range. As we know, we always have opportunity here and not in the 50% mark. So now that we have opportunity, there's a few things to do. If you're bullish in the overall uptrend that VALE is in, take the long here, stop just underneath. For me, though, I would be watching out, since we gapped down aggressively, sold off aggressively on earnings into this Friday here, I would rather be watching for a small dead cat, maybe sideways consolidation, and then a flush point to really, show itself intraday or something like that, and then break 21 to bring us about $1 lower into that 20 area of support. You can see clear, 2 times that it's acted there. So that would be my target here on VALE instead of expecting it to, double this range all the way to the downside. Because we're in a daily uptrend, I'm just not really favoring a move all the way down to about 19. Would not be interested in the short idea if 1, it never breaks 21, or 2, it retraces up, higher towards that 50 SMA, the midpoint of the range, and then retests it one more time. Wouldn't really be as interested in that instance. Next up, we'll move over to Qualcomm. This one has earnings out of the way already, and this one's an interesting trade idea simply because there's a couple of things in play. Obviously, gap up into earnings here and then holding on that Friday session. But if we look left, there still is a minuscule amount of gap left to close. So over 151.36 starts to fill this free dollar-ish, if you will, of range available up to 152.69, the low end of that, or the top end of that gap, should I say. And then after that, looking left, very emotional trading in here. I would argue that that's the next major area of resistance to pay attention to, up around 161.50. So quite a ways, quite a range up above to trade into should there be any major breakout here in Qualcomm. I would not be interested in the long trade, obviously, if we start to retest this 146.50 area, top of the gap underneath us. Obviously, that sets up a move for potentially filling it underneath. I would not take that trade per se, rather looking bullish here on Qualcomm. Next up, we have Oracle, and Oracle, although it's in a impressive daily uptrend, I think something interesting is happening here where we had a fake kind of break here. Anyone who got trapped, trying to long here, saying, okay, I'm finally comfortable taking the breakout of this bull flag. We've got a couple days of acceptance. Boom, that was all taken away from them on that red day here. And that's starting to raise into question, okay, where is the point where those people wave the white flag and say enough is enough? I just want to get out of that position. And I would argue it's underneath 86.61. If we take that out, I'd trade down towards that 50 SMA, really treating this as more of a day trade as opposed to a swing trade. But if you're someone who does the swings, fine, target the 50 SMA. That's kind of the max area I would look for, especially given the context of this major daily uptrend. But again, for a scalp trade, you're probably looking for something like 85.50, the lower wick of this red candle in here. I wouldn't really be interested in taking the setup, obviously, if we never break that 86.61 or if we start to trade above 88.58. Next up, we're looking at ZM, and this is a kind of a sleeper stock, honestly. Ever since the hype sort of died out around people working from home, so on and so forth, it's just kind of been off my radar, but it's coming back into this resistance trend line on a higher low, right? So we have this here as a higher low. This was your major low from back here. I like the proximity of time in between touches here. So everything about this is just kind of screaming, okay, next test of that resistance trend line probably should take it out. So to me, if you want to be conservative, it's a break over 400. Your next target, just walking it up, is around 441. You can see prior cluster of highs in there. And then after that, you would just trade up towards this one. That's a little bit of a stretch for the upcoming week at least, but that's how I would think about that should a larger breakout develop here inside of ZM. Obviously, inverted hammers there on Thursday and Friday. So kind of be patient, wait for the break. break. I'm not saying just long it immediately here. Obviously, another higher low would be ideal, something that forms above our 355.40. Not really interested in the trade if we trade underneath the bottom end of this sort of zone that we've mapped out at 343.51. That's ZM here. And then lastly, someone was asking about the TNX inside of the Discord. We cover this every Wednesday, by the way, in the midweek market update. If you're not watching those, go ahead and watch those. It's more of an in-depth analysis of the S&Ps as opposed to all these companies. And we usually throw some trade ideas in there at the end as well. Anyways, in an obvious downtrend, right, falling out of this area of consolidation, there's not a whole lot to talk about here, especially noting how flat it was on the FOMC day on Wednesday. I mean, there's a complete disconnect between what's going on in the TNX, what's going on in the tech sector, as well as the banks and financials. I mean, it's slightly there, but it's not nearly as powerful as it used to be per se. Obviously, when the TNX moves lower, that's not going to be good for your banks and financial sector. And if it moves higher, that's not going to be good for your XLK, the tech sector there, as rates go up. So that's the push and pull that you pay attention to. As it sits right now, it's just, very, very sideways around this 1250-ish mark, there, which equates to, of course, a 1.25 rate on the 10-year Treasury. So again, there's just not a whole lot to discuss. Higher's bad for tech, lower's bad for financials. That's the push and pull that you watch inside of the S&P. So hopefully that was at least a little bit insightful. I'm not going to read too far into it. We can quickly check out the ZN, which of course is the note futures, and this is inversely correlated to what we just discussed on that TNX there. So maybe there's a breakout point over here over the 185 handle, somewhere over there. It starts to get going to the upside, which obviously is not going to be good for the financial sector. So I don't know, just things to think about. But as it currently sits, it hasn't been the end of the world. It hasn't really proven to have a huge, massive impact inside of the financials or the tech sector. So if you found this video useful, if you enjoyed the content, if you like the trade ideas, anything, let me know down below inside of the comments section or by simply leaving the video a thumbs up. And with that being said, I wish you all a green trading week.